Hello, my dear students. This is to welcome us to second semester for this academic session. The course we're going to be looking at is ACC121. That's a course code, and the course title is Introduction to Accounting II. It is a course that is taken by all undergraduate students, particularly those in accounting, and we'll come to see that there are other programs that actually take this course. The language of instruction is strictly English, and it is a core course, even though in some departments they may have it as elective, but in accounting, especially in Faculty of Administration, it is a core course. It is a 3 credit unit course to be taken by those in 100 level. By the code, you can see that it starts with 1, ACC 1. The one there tells you it's a 100 level course. But that doesn't mean that those in 200 level who have a carryover in the course cannot take the course. There are a number of programs that actually take this course. We have BSc Accounting, BSc Business Administration, BSc Banking and Finance, BSc Public Administration, and of course, we have BSc Economics and BSc, BEd. That's those in education, BEd, uh, BEd education, BEd economics education. This course is designed to be taken by a number of lecturers. I happen to be the lead lecturer. My name is Dr. Ismail OLOTU Abdullahi. We have Dr. Esa Iyere, who is also taking, will also take certain components of the course. We have Dr. Musa Yudoshiro, who will also take a certain portion of the course. We have Dr. Halimatu Sadia Abubakar. We also expect that she will take a certain components of the course. We have Dr. Hassan Musa, Dr. Usman Musa, Aliyu Muhammad Nasir, M.I. Menoma, Dr. Usman Makama, Umar Ibrahim Ohinoi, and then Liman A. Mohammed. We will all take certain components of the course as we progress. For communication to the group, we'll use my personal Unsuk-based email address, and I will relate whatever information that is sent to this mail with respect to this course to my colleagues taking the course. The lecture hours ordinarily is supposed to be 3 because it is a 3 credit unit course. So we expect in the physical class we will take the hop to deliver this within 3 hours as much as possible. The course overview. The course basically provides a comprehensive understanding and application of the accounting principles and practices that we have actually learned in the first semester, with a particular focus on preparation of financial statements, making adjustments to accounts of sole proprietorship or sole traders, manufacturing, and non-profit making organizations. The course also include important topics like error corrections or correction of error as the case may be, control accounts, and bank reconciliations. And these are very important components of financial reporting that are required in ensuring that we maintain accurate financial records in accounting. At the end of this course, as part of the learning outcome, each student is expected to identify and correct at least 5 types of errors, prepare final accounts of a sole trader, prepare final accounts of a manufacturing entity, prepare both sales ledger and purchases ledger control accounts. We also expect that at the end of this course, each student should be able to explain at least 3 reasons for variations between bank balance in the bank statement or balance on the bank statement and the balance we have in our cash book. We also expect students at the end of this course to prepare a bank reconciliation statement. And then lastly, we expect that uh, students, after going through this course, should be able to prepare um, a final account of a non-profit making organization. The topics to be covered for the weeks we have in this semester include correction of errors, which will be taken in week one. In week two, we'll be looking at final accounts of a sole trader. Specifically, we'll focus on statement of comprehensive income, which we used to call trading profit and loss account. Then week three, we'll be looking at final accounts of a sole trader. Again, specifically in week three, we'll be focusing on statement of financial position. Week four, we'll be looking at how to treat accruals, repayments, and other adjustments that we may come across as we prepare books of accounts of sole trader and probably other business organizations. We expect to intensify more demonstration of that in week five. And then in week six, we'll be looking at manufacturing accounts. Specifically, we'll be looking at the statement of comprehensive income and statement of financial position of manufacturing organization. Then in week seven, we'll focus on bank reconciliation statement where we'll learn how to prepare bank reconciliation statements, identify why we have variations between the balance we have in the bank statement and the balance we have in the cash book. In week 8, we'll be looking at control accounts, specifically sales ledger control account and purchases ledger control account. Week 9, and 10, we'll be looking at how to prepare accounts of non-profit making organizations. We expect to cover issues relating to receipts and payment account, income and expenditure account, statement of accumulated funds, balance sheet with respect to organizations that are set up not to make a profit, but they engage in business transactions. Then in week 11, we'll wrap up for the semester with an introduction to conceptual framework for financial accounting. The assessment criteria, because we're expected to be examined, we have two major assessment criteria. The first one is that we'll have a continuous assessment test which will take 30%, if you like 30 marks. And then we also have exams that will cover about 70 marks. If you add these two together, you have 100 marks for the course. For attendance, the rule for attendance is that attendance and participation, both physical and virtual, are expected to be compulsory for all students. Reason being that for this semester and going forward, we are expected to have our lectures in two modes, i.e., the physical mode and the virtual mode. The physical mode will require that we'll be in the class physically, while the virtual mode will require that we can stay within the comfort of our rooms or wherever we are to log into our university elements portal and then have access to the video material and then interact, probably drop message or interact with the lecturer as the case may be. We understand that uh, the students have been grouped into stream A and stream B. So it is expected that while stream A will be in the physical class, at the same time we expect stream B, she'll be at she'll log in to hold their lectures virtually, meaning uh, the two streams will not all be in the same hall physically. Rather, if one stream is in the class, at the same time the other stream is expected to log into the university elements and portal to have access to the video materials that are uploaded for each course, and then of course the learning material that is uploaded through the platform. Now, it is also important that we refer you to a number of texts that you can do further reading. The first one is the study pack of ABWA, i.e. Association of Accountancy Bodies in West Africa. The study pack is on basic accounting procedure and systems. Then we have the renowned financial accounting made simple by Robert Igben. you can also go through that. It will assist you significantly. Then we have this is a foreign text, Stowaway Labors Ding, specifically on financial accounting and reporting a global perspective. Then we have the first book by our dear Professor A.D. Zuberu on modern financial accounting, IFRS adopted, meaning it is a text that has been prepared having in mind the format, the template for the current international financial reporting standards. We expect that you have access to any of these and you go through them. That will really help your journey as far as this course is concerned. Now, let us look at what we are to discuss for this particular week. We will be looking at uh, correction of errors. That's for week one. The components of this correction of error has to do with trial balance. We'll first of all look at trial balance and errors. We'll look at classifications of errors. We'll look at correction of errors using journal. And then we now wrap up with suspense accounts and correction of errors or error correction. So let's see what we have. First, it is important that we refresh our minds as to what a trial balance is. Towards the end of the first semester, we have been introduced to how trial balance is prepared. Recall that the accounting process normally starts from having a transaction, then recording this, getting these transactions from source documents, and then recording such information from source documents to books of original entries, from books of original entries to the various ledgers, and then if you have the ledgers, you can now extract the balances from the ledger so that you can have your trial balance. So trial balance basically is a list of ledger balances that is used to ascertain the arithmetical accuracy of the double entry system of bookkeeping. In essence, we're saying that having passed through the processes from having transaction up to extraction of trial balance, we expect that the trial balance help us to check and confirm that yes, the additions, subtractions that we must have done through the process are actually correct, i.e., they are accurate. But is that correct or is that perfect? Meaning, if we have trial balance, does that mean that we're not going to have any error? Well, we'll come to see that. But let us look at what error entails in accounting. Error or errors are mistakes that are normally made in the process of recording transactions collected from source documents to subsidiary books and up to the ledger. Now, there are basically two types of errors or two broad categories of errors as far as accounting is concerned. The first category of errors is that it has to do with those errors that do not affect balancing of the trial balance. And then the second category are errors that actually affect balancing of trial balance. By that, we are saying if you commit any of the errors that fall within the first classification, i.e., the ones that do not affect balancing of trial balance, your trial balance will still balance in spite of the fact that there are errors. The second categories are those ones that really affect balancing of trial balance, meaning if you commit any of such errors, your trial balance will certainly not balance. So let's look at the first category, i.e., errors that do not prevent the trial balance from balancing, meaning if you commit these errors, any of these errors, your trial balance will still balance, in which case it means it has actually punctured the extent to which trial balance tests the arithmetical accuracy of the entries we have in the ledger. The first one is error of omission, where transactions are completely omitted from your books of account. The second one is error of principles, where errors are committed in accounts that falls within different classification of the accounts. And then we have error of omission, where errors are committed uh, in accounts that are within the same classification. We'll come to see much more later. And then error of original entry. These are errors that have been committed right from inception and they pass through the double entry principle till the end. Then we have compensating error. These are errors that actually compensate for the effects of other errors and knocking off the effects of other errors that have been committed earlier. And then we have error of complete reversal of entry, or if you like, you can just say complete reversal of entry. These are mostly errors that are committed when entries are completely reversed. We'll come to see that as we progress. So let's see each of these in detail. The first is error of omission. For this category of errors, we say these are those errors that result from a partial or complete omission of a transaction from books of accounts. Here, the entries have been completely omitted. Once you have an entry completely omitted, it tells you you have error of omission. A good example: the trial balance of James Enterprise extracted on 30th December 2022 agreed, but the bookkeeper later discovered the following errors committed during the financial year. And what is that error? That a purchase of goods worth 3,000 naira from a supplier not debited to the purchaser's account nor credited to the supplier's account. With this, the trial balance will still balance, because what you need for trial balance to balance is to ensure that for every debit entry, there must be a corresponding credit entry. Once you have complied with this rule, your trial balance will still balance. But you can see that a complete transaction that requires debiting and crediting has been completely omitted, yet trial balance will still balance. So does that mean that our accounts are error-free? No, they are not error-free. It means we have a particular error that has been committed. Then we have errors of commission. For these are errors that actually involve posting a transaction to wrong account within the same classification of accounts. Recall in first semester we have taught the various classifications of accounts. Basically, accounts are classified into personal accounts and impersonal accounts. Personal accounts are accounts of persons, for instance, creditors, debtors, as the case may be. For impersonal accounts, these are accounts of assets, expenses, and income, as the case may be. So if you commit an error in one or two accounts that are within the same classification of account, such error is tagged as an error of commission. Example: a purchase of goods from C. Lee has been posted to the credit side of C. Clark account in error, and the amount involved is 5 million naira. Now the question is, C. Lee falls under what classification of account? Personal account. C. Clark falls under what classification of account? Personal account. Is there an error? Yes, there is an error. And what is that error? If you purchase goods from C. Lee, it is expected that you debit your purchases account and credit C. Lee's account. However, if there is a mistake that instead of crediting C. Lee's account, C. Clark, another who is probably another supplier, has his account credited instead of that of C. Lee, there is an error committed. But it is an error of commission because both C. Lee and C. Clark falls within the same class of account, i.e. personal account. Second example of a payment of 600 naira to a creditor named Ahmad, wrongly debited to the account of Ahmed. Ahmad, Ahmed are not the same parties. The first one has the name ending with MAD, and the second one has MED. These are two different persons, even going by the names. Now, if you pay a creditor, what is expected is that you debit the creditor's account because the creditor is receiving money from you. So instead of debiting Ahmed's account, it was erroneously debited to Ahmed's account, in which case double entry has been completed because cash book must have been credited. So the second entry will have been in Ahmed's account, but instead of putting it in Ahmed's account, it was posted to Ahmed's account. That in itself is a problem. But will trial balance? Yes, it will balance because both credit entry has been made, debit entry has been made, so trial balance will balance. But Has a correcting been done? No, because the 600 naira is not supposed to be debited in Ahmed's account. It's supposed to be debited in Ahmad's account. This kind of error is classified as an error of a commission. Reason being that it is a wrong entry that has been made to another account within the same classification of account, because Ahmad and Ahmed fall within the personal accounting classification in accounting. The third error is error of a principal, very similar to error of a commission. However, under this, we're saying it is when a transaction is posted to the wrong class of accounts. Remember, for commission, we said it is when it is posted to the wrong account but within the same classification. Here, the wrong account and wrong classification. Example: an amount for motor vehicle costing 513,000 naira was wrongly debited to motor expenses account. We need to understand something. Motor vehicle falls under assets account, or if you like, non-current assets account, while motor expenses fall under expense account. If you like, uh, we have if we are to go by the normal accounts classification, i.e., they are both within impersonal classification, but within the impersonal accounts classification, motor vehicle falls under real account classification, while motor expenses fall under what we call nominal accounting classification. So, for the value of motor vehicle of 513,000 posted to, which is a real account, which falls under the real account classification, posted in error in motor expenses account, which falls under nominal account classification. This is an error of what? Principle. Reason being that the entry has been made not just in the wrong account, but within, sorry, not just in the wrong account, but also in the wrong classification of accounts. Another example very similar to this one is that where you have office equipment purchased for 10 million naira and is debited to an office expense account. Again, office equipment is an asset and it falls under real account classification, while office expenses is an expense and it falls under nominal accounting classification. Agreed, the correct entry requires debit entry to be made, but it is posted to not just a wrong account, but a different class of account. Cash purchase of 560,000 naira spent for purchase of new equipment. This was debited to office equipment repairs account. Office equipment repairs account is an expense account under nominal classification of account, while new equipment account is an asset under real account. So posting such entry to office equipment repairs account tells you there is an error of principle committed. The next category of error is error of original entry. They said these kinds of error normally occur when the original amount of a transaction is wrongly posted from the source document to subsidiary books, meaning double entry is correctly done using the incorrect figure from the source, from the origin. The error has been error has been made, and subsequent entries and compliance with double entry were made with the wrong figure. A simple example is a sum of 5,500 naira received from a customer but written as 5,000, which is debited to the cash book. That's the correct thing to be done, and credited to the customer's account. That is also the correct thing to be done. In this case, double entry has been complied with, debit has been done correctly in the cash book, credit has been done correctly in the customer's account. However, the amount used is not the correct figure. So instead of 5,500, the entry made was 5,000, both debit and credit. Your trial balance will still go ahead and balance, but the issue there is that there is an error, and this kind of error is error of what? Original entry. Reason being that the error has been committed right from the origin, right from the source. Another example, a payment of 1,500 naira to a creditor has been entered as both debit and credit as 1,000. Again, double entry has been respected and complied with, but the issue there that there is an error. Instead of using 1,500, 1,000 naira was used. The next category of error that do not affect balancing of trial balance is complete reversal of entry. We said this normally occur when the double entry posting of a transaction is reversed. That is, debit entry being credited and credit entry being debited, or vice versa. So the reversal is that instead of having debit, you credited; instead of having credit, you debited. So it makes it a complete reversal. Example: a payment of 8,000 naira for stationaries by check is wrongly debited to bank account and credited to stationery account. Now let us look at it critically. If you made a payment of 8,000 for stationery by check, the correct accounting entry requires that you credit your bank account. But you can see that it is reversed. Look at it. We said we reversed it by debiting bank account, which is a reversal of crediting bank account. And then we expect that your stationary account, which is an expense account, should be debited. However, the reverse is that it was created in error. So this makes it a complete reversal of entry. Another example is the purchase of goods on credit from Musa for 6 million naira was entered on the debit side of Musa's account and the credit side of purchases account. The normal thing will have been to debit purchases account because purchase is an expense and we're receiving the goods. And then we'll credit Musa's account because Musa is our creditor and all creditors have credit balance because they give out their goods as a supply to their customers. The next category of error is compensating errors. Said these are multiple unrelated errors that will individually lead to an imbalance, but together cancel each other out. This error is when an entry in one account is cancelled out by an entry in another account. Example: the purchases account was undercast by 5.2 million, meaning you have the debit side of the trial balance lesser by 5.2. If it stops here, trial balance will not balance. But let's continue. And the sales account was also undercast by 5.2. So you see, the error committed where purchases account is less than what it should be by 5.2 has been cancelled by sales account also going less by 5.2, and that makes it what? Compensating error. The error committed here has been compensated for by another error committed in an opposite account. Now, these are errors that actually affect that do not affect balancing of trial balance. The second category of errors are, of course, those errors that could cause the trial balance not to balance, meaning errors that affect balancing of trial balance. The first one is a casting error, either undercast, overcast, as the case may be. And then we have errors of transposition. Here, this is where you change the position of numbers or figures or amounts. For instance, instead of writing 16, 1, 6, you mistakenly wrote 6, 1. Instead of writing 29, 2, 9, you mistakenly wrote 9, 2. Or instead of writing uh, 98, you mistakenly wrote 89. Any one of these falls under the category of error of transposition. And then the third one is posting one leg of transaction, if you like, single entry. In accounting is built upon the principle of double entry as propounded by Luca Pacioli, and it entails that for every debit entry, there must be a corresponding credit entry. Now, where you have a transaction and you record or post only one side of that transaction, automatically your trial balance will not balance because trial balance is built upon the principle of a double entry system. Then the fourth one is Error of partial reversal of entry. In the last previous category of errors that we looked at, i.e., errors that do not affect balancing of trial balance, we identify complete reversal of entry as one category. However, if you have a partial reversal of entry, your trial balance certainly will not balance. Reason being that trial balance is built upon the principle of a double entry system. So if you have partial reversal, meaning only one side of the entry has been reversed while the other side has not been reversed, automatically your trial balance will certainly not balance. Now let us look at each of these in detail. First, we said casting errors. This involves wrong addition of figures. It could be overcasting or undercasting. If you have overcasting, it means you have incorrectly added up a column of figures to give an answer which is greater than what it ordinarily should be. It becomes an undercast if you incorrectly add up a column of figures to give an answer which is lesser than what ordinarily it should be. A casting error is where a list of items has been incorrectly totaled up or summed up, or a ledger balance has been balanced incorrectly. If this has only been applied to one balance or to one side of the transaction, this will mean that the trial balance will certainly not balance. Let us look at a very simple example. On the 9th of May 2023, the total sales day book had been undercast by 2,310,000. By this, you're saying if your sales day book is less, or sorry, if it is overcast, it means it's more than what it should be. If your sales day book is more than what it should be by 2,300,000, what it means is that the credit side of the trial balance is overstated by 2,300,000. And what it means is that the debit side will be short of that particular figure. And because of that, the two sides of the trial balance will certainly not be the same. The second type of errors that affect balancing of a trial balance is where you have transposition of figures. A transposition error describes an event where a bookkeeper accidentally reverses two adjacent digits when recording transactional data. This is the misstatement of account balances while drawing up an account. An example: goods worth 4,510,000 sold to Mr. Torimiro had been posted to his account in error as 5,410,000. The transposition here is look at the position of 4 and 5. That's 4,500,000. You can see in transposition, you're supposed, instead of starting with 4 then 5, you now have 5 then 4 in error, and that gives you a totally different number. Now, one unique thing about this error of transposition is that in most cases, where you have where you get to know that there is a transposition of figures in your trial balances, when you realize that the difference between the difference in the trial balance gives you a figure that is divisible by 9. It tells you there is a possibility of what? Transposition of figures in your records. Then you go back to your books and start checking. Are there figures that ordinarily you should have written them in a particular way, but you transpose the number? Let me give us a simple example. If you are supposed to write 89 and you went and wrote 98, you realize that the difference between 98 and 89 is 9. Another example, you are supposed to write 45 and you wrote 54. 54 minus 45 will give you 9. Let me give something wider. If you are supposed to type 81 and you went and typed 18, the difference between 18 and 81 is 63. 63 is divisible by 9. So in most cases, if the difference you have in the trial balance is a figure that is divisible by 9, regardless of the nature of the figure, it tells you that there is a possibility that the error committed is that of a transposition of figures. Next, we have errors in posting to one leg of a transaction. If you like, single entry. Excuse me. Here, we say it normally happens when one leg of the double entry for a transaction is not posted, meaning you were able to do one side, one entry, and you couldn't complete the entry. Example, goods of 2,400,000 sold to Mr. Soldier had been posted to the debit side of his account, but the second leg of the transaction has not been posted to sales account. In accounting, if you sell goods to your customers, the two accounts involved are the customer's account, i.e. your debtor's account or accounts receivables account, and your sales account. Because the customer is receiving from you, you're supposed to debit the customer's account. And because you are giving out, you credit your sales account. So in this situation, we have a situation where the entry has been posted to the debit side of soldier's account. That's your customer, and that's the correct thing to be done. However, the corresponding entry should have been to the credit side of your sales account, and that hasn't been done. If that happens, you have a single entry, i.e., posting of one leg of a transaction, and that can easily affect balancing of your trial balance. How? If you record 2.4 to the debit side of a soldier's account, it means the debit column of the trial balance will be higher than the credit column of the trial balance by 2,400,000. The next category is error of partial reversal of entry. Now we said it normally involves reversal of one leg of the double entry for a particular transaction. Example, the double entry for salaries paid by cash normally requires that you debit salary account and you credit cash account. Now, if salary account has been debited correctly, and in error, cash account is debited. That means you end up having debit instead of debit credit, because double entry says if you have debit, you should have credit for each transaction. But there are instances where you have debit, which is the correct thing to be done. Instead of having credit, you end up debiting. And in that case, instead of having debit credit, you end up having the debit. If you have such situation, it is a partial reversal of entry, because it is only on one side that you reverse the entry, not the two sides. Recall that if the reversal is complete, meaning both sides have been reversed, trial balance will still balance, and that will be complete reversal of entry under the first category of errors that we have identified earlier. Second example, if you have a double entry for payment of rent that is made by check, the requirement is that you debit rent account and you credit your bank account. Now, if rent account is debited, that's the correct thing to be done. However, if you mistakenly debit bank account, you will still have debit instead of debit credit. And in this case, it is only one component or one side of the transaction that has been reversed, and that makes it a partial reversal of entry. Now, if we have errors, what do? We need to correct them. How do we correct them? We correct them through the means of journal, specifically journal proper. One of the uses of a journal proper is to correct errors. We have discussed different kinds of books of original entry, one of which is a journal in the first semester. Now, a journal, recall, is a chronological record of the transactions of a business entity that is normally in the form of a diary, that is used to record transactions before they are posted to related ledgers. We use the term diary because in diary, what you use, the record you post into your diaries, they are mostly your daily records. And journals in accounting record daily transactions. If there are credit transactions, we have a specific journal for that. If there are cash transactions, we take them to either the cash book straight, or we could also record them in a journal book. However, if errors are committed, that's where our attention is. We take such corrections to journal proper, and that's all we're going to look at. This is the format. Sorry, this is the format for um, journal proper when we are to correct error. In correction, we identify the accounts to be debited to correct the error, and then we identify the account to be created to correct the error. The account to be debited is normally stated first, and then we place the amount under the debit column, and the account to be created comes next, and then we place the amount under the credit column. And because the journal has other purposes or function, it is important that we indicate or we provide a narration to simply tell whoever goes through the record what actually has taken place. And in this case, we can start with the word "P transaction debited or credited, now corrected," depending on what kind of error has been committed. Now let's take an illustration. The following transactions occurred in the books of Amasco Enterprises. First, a business receives an invoice for 250 naira from a supplier which was omitted from the books entirely. From the little interaction or the little knowledge we had earlier, this tells you error of omission. In most cases, the word omitted or omission shows up when you have cases of error of omission. In most cases, not in all cases. The second one, repairs worth 150 naira were incorrectly debited to non-current assets, i.e. machinery account, instead of repairs account. Repairs account falls under the nominal classification of account, while machinery account falls under the real classification of account. So it tells you that an entry has been made in the wrong account and wrong class of account. This is a classical example of error of a principle. Then we have the next error. Telephone expenses 514 naira are incorrectly debited to electricity account. Now, telephone expenses falls under nominal account classification. Electricity account falls under nominal because they are all expenses, so they fall under nominal account classification, meaning they fall within the same class of account. However, taking a telephone expenses to an electricity account is a wrong thing to do. In which case, what it tells us is that this is a clear case of error of commission, where you post wrong entry, you post an entry into a wrong account within the same class of account. The last transaction is a page in sales day book has been added up to 28,425 instead of 28,825. This is a clear case of error of original entry. Reason being that from the day book, the next point of record is, of course, the ledger, i.e., where you have the sales ledger, uh, 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 sales ledger, where you have the customer's account. You post the wrong entry and sorry, the wrong amount, and then you have the general ledger where you have sales account. The wrong amount has also been transmitted because the error had been committed right from the origin. Now, we are required to use the information we have above to correct these errors by means of journal entries. Let's see how that works out. Now, in correcting errors, it is important that we identify the accounts that are involved. So let's go back to the first information that a business receives an invoice for 250 naira, excuse me, from a supplier, and this was omitted from the books of account entirely. Now, the two accounts involved here are that if you receive an invoice from a supplier, it means there was a purchase you actually purchased. So the two accounts involved will be your purchases account and the supplier's account. Because you are purchasing, you are receiving the goods. Purchases need to be debited. And because your supplier is shipping down the goods to you, is releasing the goods to you, your supplier's account needs to be credited. So let's see what was actually done. Can you see? Purchases debited because you're receiving the goods. Trade accounts payable credited, if you like. That's a technical correct name or correct title for your suppliers if you open account for them. So trade accounts payable represents your creditors or your suppliers, and they maintain a credit balance. Now, by doing this, it means you have effected the correction. And the narration is being omission of accounts payables from books of prime entry. The second case is repairs worth 150 were incorrectly debited to non-current assets, i.e. machinery account instead of repairs account. The correct thing uh, to be done is that we are supposed to debit repairs account, but we mistakenly debited machinery account. So what we're supposed to do is to take this amount from machinery account and then hand it over or post it correctly in repairs account. Recall that the 150 is already on the debit side of machinery account. So to take it away from that, you post 150 on the credit side so that it will cancel out um, or take away the 150 that has been included in the debit side of that account that shouldn't be there. Now, it means you credit machinery account and then you do the correct thing by debiting repairs account. So let's see what we did. Repairs account debited, yes. Non-current assets, i.e. machinery account created, that's correct. And what is the narration? Being correction of an error of principle. Recall I told us that this is a case of error of what? Principle. Reason being that repairs account falls within the nominal classification of account, while machinery account falls within the real classification of an account. And that tells you wrong entry made not just in the wrong account, but also accounts that are not within the same classification. The third scenario states that telephone expenses of 514 naira are incorrectly debited to electricity account, meaning there is an error. And how do we correct it? We need to take away the 540 from telephone expenses account, and then we remit it to electricity account. How do we do that? Already this 540 is erroneously included on the debit side of telephone expenses. So we need to credit telephone expenses account, and then where it should go ordinarily should be electricity account. So as we are taking it away from telephone expenses account, electricity account should be able to receive that amount. And if electricity is receiving, it means we debit electricity and then we credit telephone expenses because telephone expenses need to relinquish that amount. So let's see what was done. Exactly. Telephone expenses, uh, I'm coming. Telephone expenses incorrectly debited. Sorry, it is incorrectly debited to electricity account. So what were I guess I reversed the explanation that an amount of 540 that should be in telephone expenses wrongly debited in electricity. So it is electricity that should give out and then telephone expenses should receive. So if telephone expenses is receiving that amount, we debit telephone expenses. And because electricity need to give out that amount because it shouldn't be in it in the first place, we credit electricity account. So let's confirm that yes, telephone expenses is receiving, we debit. Electricity should give out, we credit. This kind of error is error of commission. Reason being that for error of commission, we say it is an error that is committed in a wrong account within the same classification. Both telephone expenses and electricity expenses fall within the nominal account classification, and this is a perfect case of error of commission. And then lastly, we have a page in sales daybook has been added up to 28,425 instead of 28,825, meaning from our sales daybook there is a problem, and the problem is that we have understated the value of our sales made on credit by 400 naira. How did we get the 400 naira? 28,825 minus 28,425 will give you exactly 400. So what do we do to correct that? We need to identify the accounts that are involved. The two accounts involved will be your customer's account and your sales account. Your customer account ordinarily should be debited, while your sales account should be credited. Now, the issue there is that the debit and credit has been done, but with an amount that is less than what it should be by 400, both debit and credit. So to correct this, what we can do is that we add 400 naira to what has been posted in error to what do you call it, the two accounts. So how do we do that? Your customer account maintains a normal debit balance, so and the amount there has been less has been included in error, sorry, has been posted in error with 400 naira by 400 naira less. So what we need to do is to add more 400 naira so that it can meet up with the 28,825. In which case, what it entails is that we debit our customer's account and then credit our sales account, because sales maintains a normal credit balance. And if sales account is less by 400 naira, it means we need to credit sales account by 400 so that we can effectively correct this error. So let's see. Yes, trade account receivable 400. That's your customer's account is debited by 400. It means you are increasing the amount there to meet up with the 28,825. Then our sales account is credited. That's correct, because we have 400 naira less in our sales account. So crediting sales account means we are adding 400 naira to that account, being correction of casting error right from the origin. This is a clear case of error of error of original entry as a result of casting. In most cases, it is casting error that you like looking. So how did we arrive at the 400? We said the difference between 28,825 and 28,425. Now, the next is to look at the suspense account and error correction. Now, first, what is suspense account? Let me give an insight into what it entails. In a situation where, as an accountant or as a bookkeeper, as you are preparing your records, it is expected that you extract your trial balance from the ledger balances, and then from there you go ahead and prepare your final account. Now, where you have situation where among the four classes of errors that affect trial balance, you have one, two, or probably all of such cases in your books of account, it means your trial balance will not balance. So in the meantime, it is normal for you to create what we call a suspense account. And in that suspense account, you will keep the difference you have in the trial balance in that particular account to help your trial balance in quote, while you take the necessary step to investigate what happened, where did you go wrong, where exactly is the error. If you identify them, you correct them, and then you clear such an account. It is expected that if you have opened a suspense account to help balancing the trial balance temporarily, and after that you investigated the reasons or why you have such errors, and you have been able to identify all of them and you have corrected them effectively, the suspense account balance should be nil at the end of the day. So what is this suspense account? We said it is a temporary account that is created to record the amount causing the difference between the debit side and the credit side of the trial balance. Let's demonstrate or let's illustrate this. At the year end of T. James and Co., an imbalance an imbalance in the trial balance was revealed, which resulted in the creation of a suspense account with a credit balance of 1,500. Investigations revealed the following errors. One, a sale of goods on credit for 1,000 naira had been omitted from the sales account. You can see it is only the sales account that is affected. But the other account, which of course is your debtors account, has been taken care of. But the sales account, where you're supposed to have a credit entry, completely it is not included. So what it means is that your debit side of trial balance is likely going to be higher than the credit side of the trial balance. Number two, stationery purchase by 200 naira, by cash for 240 naira, completely omitted from the books. This is a clear case of error of omission. Remember, for error of omission, it certainly will not affect balancing of trial balance. So it will not form part, it's likely not going to form part of the 1,500 naira challenge that you actually have. But for the first case, certainly it will affect balancing of trial balance. So it may account for the 1,500 naira difference that you have. The third case is a purchase of raw materials of 350 naira had been recorded in the purchases account as 850. There are two accounts that are affected by this. Now, if you purchase raw materials, uh, if it is by cash, you're supposed to debit your purchases account and then credit your cash account. If it is on credit, it means you debit your purchases account and credit your supplier's account. The focus here is that while recording it in purchases account, instead of using 350, we went and used 850. However, the other account has no problem because by this information, it means it is only purchases account that we have this error in it. And it's not a case of a transposition, rather it's a case of overcast because instead of having 350, you went and recorded 850, which is an amount higher than the 350 that it should be. What are we required to do? First, we're to prepare journal entries to correct each of the above errors. We may not necessarily give a narrative based on the requirement here, but if you can give, there is no problem. Second requirement is for us to open a suspense account and show the corrections to be made. Recall, if these are the only errors that resulted to this trial balance not balancing, and if we correct them, if we effect this correction the way they should be effected, it means we are not supposed to have any balance left in the suspense account. So let's see. Now, before we go into that, let me just give us an insight that if you have an error that affects balancing of trial balance, technically, once you identify, in most cases, you realize that the error that you may have committed will affect only one account. It means the corresponding account to effectively correct that errors will require that you fall back on suspense account. For instance, if you look at the first illustration, a sales of good on credit for 1,000 had been omitted from sales account. Sales account is worst hit here. So to correct it, you will do the needful in sales account. The corresponding entry will automatically be your suspense account. So let's see. What do we need to be done? If you have a sales of goods on credit for 1,000 and it's not included in sales account maintains a normal credit balance. So for you to correct it, you need to include this 1,000 in your sales account. Including it in your sales account means you need to credit your sales account. So what happens to the debit entry so that you can have a complete double entry principle being applied? It means the debit entry will automatically be to your suspense account. Reason being that it is this 1,000 naira is part of why your trial balance did not balance by 1,500 and you kept that difference in a suspense account. So it is expected that you go back to suspense account and take that off so that that account will be nil at the end of the day. So let's see, is that what has been done here? Yes. Suspense account is debited. sales account is credited. Reason being that there is an error that has been made, and it's specifically single entry, because while your customer's account has been debited, the corresponding entry should have been in sales account, but that was omitted. So if you have to correct it, you credit your sales account, and because this error affects balancing of trial balance, what happens? You debit your trial balance. Let's look at the second situation. The second case says that stationery that was purchased by cash for 240 naira was completely omitted from the books. It means both stationery accounts and cash accounts have no record of this 240 naira. Recall, we said that this kind of error does not affect balancing of trial balance, and because of that, it shouldn't find its way. You won't have this 240 anywhere close to 1000 anywhere close to the 1,500 naira that is in suspense account. Now, how do we correct this? The correct thing to be done is to identify the accounts involved: stationary account, cash account. What do we do to cash if we are paying? We credit cash. What do we do to stationary if we are purchasing? We debit stationary. So let's see, what did we do? Stationary account is debited 240. Cash account is what? Credited with 240, being error of complete omission of transaction now corrected. The third case is that the purchase of raw materials of 350 naira had been recorded in purchases account as 850. Now, the account that is hit by this error is your purchases account. Purchases account maintains a normal debit balance. So where you have 850 instead of 350 on the debit side of purchase account, it means you have overstated the amount that is in your purchase account by how much? By the difference between 850 and 350. If you deduct 350 from 850, you're going to have 500. It means your purchase account has been overcast or overstated by 500 naira. So if you have the debit side of purchase account higher than what it should be by 500, for you to correct, you credit your purchase account, meaning you are reducing your purchase account by the value of 500. So what do? We credit purchases account by 500. What happens to the debit entry? Because this error will affect balancing of trial balance, we debit our trial balance by 500 naira. So let's see what we have done. Recall, we said the correct thing to do is to credit purchase account by 500, debit suspense account by 500. So let's see what we have done. Suspense account debited 500, correct. Purchases account credited with 500, correct. The reason being error of a transposition of a figure, now corrected. It's really not transposition, because you are not 3 and 5, 3, 8 and 3 are not transposition. Rather, this is a case of overcast. I think we'll edit and correct that appropriately. Now, that is the first requirement. The second requirement says we should open a suspense account and show the corrections that have been made. Recall that there are two cases that affect a suspense account. Here we say suspense account should be debited by 1,000. Another suspense account here by 1,000. So if we open suspense account, we should see this 1,000 on the debit side with the name sales, and we should see 500 on debit side with the title purchases. Recall that the suspense account, we're told, has a credit balance of 1,500. Let's see. Suspense account. The credit size, end of year balance is 1,005. While our correction says sales account should be what? The suspense account should be debited by 1,000, and that's the 1,000 we have here. Our sales account, our purchases account, look at it here at the bottom. Here, for purchases, we say suspense account should be debited by 500. So let's see. You can see on the debit side, 500. 1,000 plus 500 will give us 1,500, and that will knock off this. At the end of the day, we shouldn't have any balance left in the suspense account. the credit side of the credit balance of the suspense account now has been cleared by the correction of the errors that we have made, totaling 1,500, and it means we have effectively corrected these errors that have been identified. Now, ladies and gentlemen, that is the much we can take. However, we are leaving you with an assignment for the week. It is expected that you go through this assignment and you attend and answers to these provide answer to these task that has been put forward before you. The trial balance of Man and Co. Limited shows a deficit of 780 on the credit side, and this difference was posted to a suspense account. Upon examination of the records, the following errors were discovered. Purchase day book was overcast by 100, bank charges 220, which was entered in the cash book, have not been posted to the bank charges account. A sale of goods to Kelvin for 2,300 naira was correctly entered in the sales book but entered in the personal account as 3,200. What are you required to do? A. You have to first of all identify the kind of errors above. For in each case, tell us what type of error it is. Then you have to show the requisite journal entries to correct these errors. You have to write up the suspense account showing the correction of the errors, and then we expect you to define what suspense account is. Thank you very much. Do have a wonderful day.